Welcome to the latest edition of Fundamentals. This time around, I'm going to look at an actively managed member of our list of 72 favourite funds, namely Polar Capital Global Technology. Now, as its name rather suggests, the fund seeks to generate long-term capital growth by investing in global technology stocks. The portfolio may generate some income in the form of dividends, but income is not the goal here. The fund was launched way back in 2001, although on this occasion we are talking about a share class that began in 2009. What this does mean is that anybody putting money into the fund will have an experienced team of fund managers on their side, led by Nick Evans and Ben Rogoff, and in such a fast-moving field as technology, this is important. The sector and the many industries it covers are constantly changing, and anyone looking at tech stocks knows that obsolescence is one of the biggest risks facing any company that operates within them. So, having someone who's seen many product cycles running the fund should be, in theory, an advantage. The fund's got $2.2 billion, or £1.5 billion in assets under management. The managers will take a geographically diversified approach, and there are no specified limits on investing in any geographical region or specific country. At the moment, as we can see here, just under 3/4 of the assets are invested in the USA, which is understandable given the role of Silicon Valley and America's traditional strength in tech. Asia represents around 12% of the fund, Japan nearly 10%, and Europe the bulk of the rest, although there is no weighting at all toward the UK at the moment. The portfolio is pretty broad, with 72 individual shareholdings, and the top 10 picks represent just over 1/3 of the assets. The largest positions at the moment are Facebook, Alphabet, the parent of Google, Microsoft, Apple, and Chinese internet giant Tencent, with Amazon.com, American silicon chipmaker Advanced Micro Devices, and another online Chinese behemoth Alibaba not too far behind. The fund comes with an ongoing charge figure of 1.16%, so you do have to pay for the manager's expertise. Polar Capital Technology is eligible for SIPs, ISAs and dealing accounts, and the minimum investment is just the one share. And for those who put faith in such things, it's got a 5-star ranking from Morningstar. So, those are the mechanics. The next question to address is why investors could consider this fund for portfolio inclusion today, and I think there are 3 perfectly possible reasons. The first is that we are still really operating in a world where GDP growth is relatively subdued. So if any company proves it's capable of generating sustainable, high rates of profits growth on a secular organic basis, thanks to the strength of its product or service, then it could well become very highly prized, drawing a lofty valuation and potentially providing strong share price performance for investors. The technology-laden Nasdaq Composite Index in America trades near all-time highs for this reason, after a thumping good run since the start of 2017. Second, the fund has no shareholdings at all in the UK. This therefore provides some geographic diversification for investors and exposure to an industry where the UK stock market's got a pretty low weighting. You may also view moving beyond the UK as a good thing for other reasons, not least the FTSE 100's poor recent showing, which meant the UK was one of the worst performing major stock indices in the first quarter of the year. Finally, this fund has built a good track record of delivering on its mandate by providing capital growth to patient investors. Since the launch of this particular share class in 2009, the fund has risen in value by over 350%. However, we must always remember that past performance is no guarantee for the future, and the Polar Capital Global Technology Fund may not be suitable for all investors, also for 3 perfectly possible reasons. First, as we've seen just this year with the shakedown in Facebook amid the ongoing Cambridge Analytica data scandal, the value of technology shares can fall just as quickly as they can rise. Second, again, as already mentioned, tech stocks are driven by near-term momentum and long-term growth. But there are few worse investments than a growth stock that disappoints on near-term earnings or even goes ex-growth, as they often come with lofty valuations that offer little downside protection if anything goes wrong. We can see this now in not just Facebook, but Tesla too, and even Amazon is coming under pressure as President Trump, no less, questions whether the firm is doing damage to the US Postal Service and rival retailers, or whether it's paying enough tax. To take an extreme example, let's look at the last time everything looked rosy in the technology garden. If you'd put your money into what turned out to be the peak of the tech, media and telecoms bubble, when America's Nasdaq index hit 5,048 in March 2000, it'd have taken you 15 years for you to get your money back. Finally, there's always that nagging worry about legendary US investor Warren Buffett's warning about how, quote, you cannot buy what is popular and do well over the long term. There can be no doubt that tech's popular right now. 6 of the world's 7 biggest firms by market capitalization are tech stocks, as are 10 of the top 25. So what, you might say? But had you bought the world's top 25 stocks by value at the peaks in 1999 and 2007, when everything looked great, you would have lost money on a 1, 3, 5, 10 and to date view on the 1999 names, and on a 1, 3, 5 and 10 year view on the 2007 names, on which you'd now be just about break even. This is not a prediction that tech stocks are about to crash, not a prediction the stock market's about to peak, or a prediction that Polar Capital global technology funds managers will fail to spot the next round of technology trends and miss the next round of big winners. But what it does go to show is that investors must therefore do their research on Polar Capital Global Technology Fund to make sure that it fits with their overall strategy, target returns, time horizon and appetite for risk before they put any capital to work. Thank you for watching, and I look forward to seeing you next time.